Hi, everybody. I know there's a couple names that I haven't met before, and maybe there's a couple people that haven't met Evan before. So me and Evan, we make up Retirement Income Group along with Stephen Way and Sam. A couple of years ago, me and Evan worked together. We were the high net worth wealth advisors at one of the big five banks, where we actually used to work with Wilmot. We partnered with him on several things. So, a couple of years ago, we left and decided to create our own company called Retirement Income Group. And we're really excited to have Wilmot back as well as a partner to talk to everybody. He's a great speaker. I've heard him speak a few times and, really exciting. He also really knows his stuff. He's a really smart guy. So, and the information he's got today, the presentation is pretty jam-packed. So I'd like to give him as much time as possible to get going. And and actually, Wilmot, do you want to give a little bio about yourself? I know you're the vice president tax and tax retirement estate planning at CI Asset Management. Is that your official title? I don't. I know there's some rebranding that went on. So
yeah, indeed. So first of all, thank you guys. It's great to be back with you again. I always enjoy partnering with you. And speaking with your clients about this stuff, right? Tax, retirement, and estate planning. Tax, retirement, estate planning, obviously a big part of financial planning, a big part of wealth planning. And we often spend so much time focusing on how much we can earn, right? How much we can get, right? Like, what's my rate of return going to be? And that's critically important for sure. But a big part of wealth accumulation is derived from what you can save, right? What you can keep in your pocket, right? The more you keep is the more you can invest. So I work for CI Global Asset Management. We've recently rebranded. Some of you might know us as CI Investments. And I work as part of a team of 5 professionals in the area of tax, retirement, and estate planning. So my role at CI is to work with financial advisors and share ideas, strategies, that type of thing when it comes to saving taxes. All right. Now, we are not anti-tax, right? We believe that, we live in a great country that we live in because we pay taxes. So we're not anti-tax, right? But we do believe in paying what is to be our fair share and no more, right? We think that we can keep as much money as we can to live off of, and when time comes for us to go, to pass those assets on to beneficiaries of our choice, right? So what our team does at CI is we spend lots of time poring over tax legislation, federal legislation, provincial legislation, estate planning legislation, retirement planning legislation, and we share ideas and concepts with our financial advisor partners, John and Evan and team, so that they can be well positioned to service you, their clients. All right, so that's a little bit about me, and what I get to do today is talk to you a little bit about COVID and how COVID could impact your tax filing for the 2020 tax year. John and Evan has also given me the opportunity to speak very in that we're in right now. So we're going to take a few slides just to talk about that. And we're also going to talk about some tax filing tips or mistakes that you might want to avoid, common mistakes that Canadians often make when filing their tax return. We want to highlight what some of those mistakes are so that you avoid those mistakes and maximize the amount of money that you can keep as opposed to giving it to the tax man, right? So I'm now going to put my slides up on the screen here. If you guys bear with me one moment here while I do that. And John or Evan, just give me a thumbs up to let me know we're good.
Yep, we're good.
And I'm going to get right into our deck today. All right, so we're calling this presentation COVID-19 and Your Taxes. Now, one of the reasons why I prefer face-to-face presentations as opposed to this type of environment is because I like to look at the audience. I like the audience to look at me eye to eye. And as we talk and the presentation becomes more of a conversation, a two-way dialogue, as opposed to just a information dump or lecture by me. But when
so actually, on that note, we have a Q&A function here as well. So yeah, if anybody has questions, don't hesitate. Type it in the chat or in the Q&A. I'm going to be watching it, so I'll interject if there's any questions and ask it for you as well. Yeah, jump in time to time. You'll have to stick to just seeing me and Evan though. Hopefully that's all right.
So yeah, that's certainly fine. Type whatever questions you have in the Q&A box. There are some spots throughout the presentation where we can stop, we can take a few questions, and we'll also do a Q&A period at the end, right? So if I get through the slides efficiently, we can take some time at the end to do a little bit back and forth Q&A. I trust and hope that I can answer a lot of your questions. What questions I can answer, it'd be my pleasure to work with John and Evan and yourselves to get answers to your questions. All right, so let's get right at it. The first slide that I want to speak to is a slide that I've already spoken to actually, right? I talked about keeping as much as you can, right? Minimizing taxation to maximize your wealth, and that's what this slide speaks to. Wealth accumulation. The more you keep, the more you can invest, right? So what this slide is telling us is, you know, we're focusing here on investment income, right? But we can apply this same concept to other types of income, employment income, self-employment income, right? Rental income can be included in this conversation as well. And when we look at Canada's tax system, and we'll dive into Canada's tax system a little bit more here in a moment, but when we look at Canada's tax system, there's different types of taxation depending on the different types of income that we earn, right? So some forms of income are what some might call inefficient income from a tax perspective, because they're taxed at what we'll say is the least efficient tax rate, right? So interest income, for example, if you earn $10,000 of interest income, right? What this slide is telling us is of that $10,000 after tax, you get to keep $5,500. You're paying the tax band $4,500. Well, those rates are actually quite low, to be honest. The truth is the average tax rate, the top tax rate in Canada is higher than 45%. In Ontario, the top tax rate is actually 53%. We'll talk more about that in a minute. But the bottom line is interest income and rental income and employment, self-employment income, you know, are taxed at a rate that's much higher than, for example, dividend income or capital gains, right? There's also something known as a return of capital, which is a return of your own money, which obviously is not taxable because it's a return of your own money, which is why we call it return of capital, right? Now, my focus here today is not to do a deep dive on the taxation of interest versus dividends versus capital gains. John Evans can talk to you about that. We can talk about that later. The point I'm trying to make is when you're thinking about tax filing time, when you're thinking about the different types of income that you can earn, also think about the tax angle. Because if you think about the tax angle in the context of your complete financial situation, it can help you to better understand and better choose suitable investments and investment opportunities. Okay, all right, let's move on. Our agenda for today is all about taxation, minimizing taxes, right? What we're going to do is we're going to look at Canada's tax system, and we're going to look at some important deadlines as they relate to the 2020 tax filing year. Okay, we're going to look at COVID-19, obviously. The title of the presentation is COVID-19 and your taxes. So we're going to look at COVID-19 and what impact COVID-19 will have on your 2020 tax return. So COVID-19 in your taxes, and tied into that is COVID-19 in your home office, because many Canadians have been forced to work from home because of COVID-19. Well, what does that mean for the increase in your home office expenses? home office expenses that you may have incurred that you wouldn't otherwise have incurred if you were going out to work. If you're forced to work from home, has the government offered any flexibility or tax savings for you in respect of having to work out of your home office? We're going to talk about that in a minute. And now we're going to look at common tax filing mistakes. And then, as mentioned, RSP season considerations, opportunities. The RSP deadline is fast approaching. I believe it's March 1st, I think. It's fast approaching. So we want to be mindful of that and consider any required contributions to RRSPs. All right, so let's get right at it. Let's talk about Canada's tax system and important deadlines for 2020. Canada's tax system is what we call a graduated tax bracket system. As income increases, your tax rate will also increase. So if I'm earning between $0 and $45,000, right? My first zero between my first $0 to $45,000 is taxed 20% in Ontario. I'm just talking about other income here. Other income is employment income, self-employment income, interest income, rental income. That's other income. Then we have capital gains, then we have Canadian dividends, which are subject to different tax rates. But for purposes of this conversation, let's talk about other income. My first $0 to $45,000, subject tax at 20%. Once my income goes beyond 45,000, so 45 to 49, now that portion of my income is taxed at 24%. 49 to 79, that portion is taxed at 29%, and so on and so forth. So what you can see here is for a resident of Ontario, once income exceeds $220,000, any income in excess of $220,000 is taxed at 53.53%. Top tax rate in Ontario, 54%, right? So when I look at this table, when I look at this slide, two things jump out at me. The first thing that jumps out at me is I realize that for those who are fortunate enough to have income beyond, let's say, $200,000, 216 to be exact, for those fortunate enough to have an income of beyond $216,000, each additional dollar of income that they earn is taxed at beyond 50%, so the government keeps more of that money than the earner keeps. That, in my view, is a problem, right? Anytime the government's going to make more money off of me than I'm making off of me, I have a problem with it. Okay? That's the first thing that I see. The second thing that I see when I look at this table is I realize that there are many Canadians, while they're living, right, and perhaps during their retirement years, there are many Canadians who are subject to tax at lower tax brackets and lower tax rates because their income is lower than the top tax rate. But then once they die, a large portion of their wealth ends up subject to tax at 54%. Now, this presentation here today is not a presentation on death and taxes. If it was, I would dive into that concept a little bit more. But what I will say is the reason I can make that statement is because when we die, we're deemed to have sold our assets just before we died, which triggers a large taxable income for the year of death, which pushes us up beyond $220,000 for the year of death, which means that a large portion of that wealth is taxed at 54%. So when we're talking about saving taxes, yes, we want to save taxes while we're living, but we also want to think about impact at death and plan to save taxation at the time of death. And if we're planning to save taxation at the time of death, we might need to take on some additional income while we're living to pay tax on that income at lower tax rates as opposed to the top rate at death.
Yeah, and that's a great a lot of you have heard me talk about this before in the past, you know, things like earlier RSP or RIF withdrawals, you know, utilizing it throughout your entire lifetime as opposed to just waiting until, you know, your estate has to pay 54% tax as well. And, you know, just because I have had a lot of conversations with people and we do use a different chart. This chart doesn't include certain tax credits and things like your personal amount where you would get a certain amount of income tax free. But everything you're saying is, yeah, really spot on. And one other plug is we do an estate planning event every April usually. So we'll be inviting everybody to that as well. So
good. Right. So the reason I put this slide up here is because this is the anchor, right? Everything is driven off of this slide when it comes to how much tax we pay, right? So we want to keep this in mind as we move through the presentation. Let's talk about some important deadlines for the 2020 tax year. Number one, there's that RSP deadline. March 1st of 2021 is the deadline for RSP contributions that we can deduct on our 2020 tax return. All right. So to the extent that you want to try to reduce your taxable income for 2020, an RSP contribution might help you to do that. The filing deadline is April 30th, right? We're talking about tax season. Filing deadline is April 30th. Now, if you or a spouse or common law partner is self-employed, sole proprietor, you have actually until June 15th to file your return. Here's the catch, though. Even though you or a spouse or common law partner might be self-employed and have until June 15th to file your tax return, any taxes owing in respect of that return are due April 30th. Right? So in most cases, it makes sense, if you're self-employed or not, to file your tax return by April 30th so that you can pay any amounts owing by that deadline. Okay? So any tax balance due is due April 30th, 2021. Now, notice that in brackets there, it says April 30th, 2022 in some cases. And that is directly tied to COVID-19. And I'll explain that more as we go. But generally speaking, tax returns for this tax filing season are due April 30th, 2021, and in a lot of cases, it's to your advantage to file your return by that due date. Otherwise, you risk penalties and potential interest in respect of unpaid balances owed. Okay, now I'll talk about that April 30th, 2022 reference in a minute, but that'll apply only to some taxpayers, not all taxpayers. Okay, if you file your tax returns online, I believe the majority of Canadians now file online. February 22nd is when the CRA has indicated that they're opening up their online filing portal. So February 22nd is when you can gear up to start to file your returns online. And then there are some other deadlines there if you're filing T2 corporate returns. So if you've got a corporation, your T2 return is usually due 6 months after year end. If you file returns for trust, there's deadlines for that. Down towards the bottom, T4, T4A, T5s, that is speaking to when you're going to get your slips. The companies that file those slips or prepare those slips, they have a return that they need to file. They have to file those by the end of February, which is why we say usually all Canadians receive their tax slips usually by the end of February. Okay? If your tax return is filed and you want to object to a reassessment, then there's timelines, deadlines in order for you to do that. So that's important deadlines to keep in mind for the 2020 tax year. Let's now move into a deeper dive on COVID-19 and how COVID-19 is going to impact your tax returns. So the first thing that I'll say when speaking about COVID specifically is that our government, and I'm speaking specifically about the federal government, has spent north of $1 trillion on COVID-19 support, right? They spent a lot of money, okay? And there's a pretty active debate going on right now amongst tax practitioners around how the government is going to recover some of that cost. Because our government has been running deficits for a few years now, and certainly now with COVID-19, we're expected to be running deficits for the next little while. But on the road to recovery, the government will have to recover these costs in some way. So there's a pretty active debate going on right now about how the government is going to recover those costs, and some potential solutions to that have been floated out there might include an increase to the capital gains inclusion rate, right? Right now, capital gains are taxed at half of the rate that interest income is taxed at. There's some discussion about that 50% inclusion rate climbing up to maybe 66 or 75%, okay? There's been some discussion about a new wealth tax on wealthier Canadians. There's been some discussion about perhaps capping the principal residence exemption. Right now, if you've got a principal residence that you own and you sell it or you die, you're free of capital gains tax by way of the principal residence exemption. There's discussion about potentially capping that. There's discussion about increasing the HST to recover some of the costs. So there's discussion around all these things. And we don't know what direction the government is going to go in. But what we do know is that there is going to be a federal budget within the next few months, perhaps as early as next month. We usually have a federal budget in around February or March each year. Last year's was obviously, had issues with the budget last year because of COVID-19. The budget didn't happen. We didn't have a budget last year, but we're expecting to have one this year. Rumor has it will likely be the third week of March, but we'll wait and see. And in that budget, we'll see how the government wants to work to recover some of these costs. But the point that I want to make with this slide is we know that the government has spent north of $1 trillion on COVID support, and much of that money was allocated to personal support benefits such as CERB, Canada Emergency Response Benefit, such as the CESB, Canada Emergency Student Benefit, and such as 3 new Canada Recovery Benefits that were meant to replace the CERB. Those 3 new Canada Recovery Benefits began in October of last year. And the point of today's presentation is not to go through eligibility. We're not going to talk about who is eligible for these benefits. What we want to talk about is impact to tax returns. And what we know is that all of these benefits, the CERB, the student benefit, and the 3 new Canada Recovery Benefits are all taxable. So to the extent that you receive these benefits need to be reported on your tax return. The thing is, though, when the government paid the CERB and when they paid the student benefit, there was no taxes withheld on those payments. So recipients received the full payments without tax. The payments aren't taxable. You report it on your tax return for 2020, and that means taxation in a lot of cases on your tax return. Now, if your income is low enough and you have enough personal credits, the personal credits may offset that income and you might not have no tax to pay on the money. But to the extent that you've got an income that goes beyond your personal credits, then you are going to have tax to pay on your CERB payments, on your Canada Emergency Student payments for those students who receive that, and these Canada Recovery Benefits. You're going to likely have tax to pay. So that's tip number 1. Don't be caught off guard by the fact that you're going to have to pay tax likely on your CERB benefits, on your student benefits, on these recovery benefits.
Now, in the recovery benefits, they did withhold some tax, right?
They sure did. So for the CERB and the student benefit, they did not withhold any tax. But for the 3 new recovery benefits that replaced the CERB, right? Because the CERB was, the government was just trying to get money out there, and they did that for a period, and then they decided we needed to tighten this up a little bit and tighten up eligibility. So they came out with these 3 new benefits. And when they introduced these 3 new benefits, they did withhold 10% off of those payments. So you might not have to be you might not have as much tax owing on the recovery benefits, those 3 recovery benefits, but specifically for the CERB and the student benefit, there may be more tax to pay than you would have to pay for the other recovery benefits. So be mindful of that. T4 slips should be coming out shortly. For these benefits, you can expect a T4A slip from the CRA in respect of these benefits. If your benefits are coming through Service Canada, there was 2 streams where you can get these benefits. If it's coming from Service Canada, you'll see a T4E, and you would need to include those slips with all your other T4 slips when you're calculating your taxable income for the 2020 tax year. So be mindful of that. Now, the next point I want to make, also related to COVID, of course, and tax filing season, speaks to interest relief for some Canadians. Recall that I said a little bit earlier that the tax filing deadline is April 30th. So April 30th, 2021 for your 2020 tax return. If you're self-employed, you can file June 15th, but your any amounts owing are still due April 30th. Now, the government as recently as February 9th made an announcement, and they said, you know, we understand that COVID has caused some disruption and has caused some hardship, and we don't want to add to the stress of Canadians. So for Canadians who have a taxable income or had a taxable income of $75,000 or less in 2020, and also receive COVID benefits, so that would be CERB or the student benefit or any of the recovery benefits. So income, taxable income of $75,000 or less, and you also received COVID benefits in 2020, then they still encourage you to file your tax return by April 30th. But to the extent that you have tax payable, you actually don't have to pay that tax until April 30th, 2022. So there is targeted interest relief. There's not going to be any interest accruing on your debt, provided you pay that debt by April 30th, 2022, as opposed to 2021. Okay, so that was just recently announced. That was announced on February 9th, and it's targeted. So it doesn't apply to all Canadians. It only applies to those Canadians who have a taxable income of less than $75,000, or I should say 75,000 or less, and you also received COVID benefits, all right? Now, even though there is this interest-free period, the government is still encouraging you to file your tax return by April 30th of 2021, because to the extent that you receive other benefits that are based on your tax return, families that receive the Canada Child Benefit, OAS recipients, or GST or HST credit recipients, those are all based on your tax return. So if you're filing your tax return late, it can throw off receipt of these benefits, all right? So the point here is still file your tax return on time, but if you fall into this category here of 75,000 or less, then you may not have to pay your amount owing until April 30th, 2022. So keep that in mind. That's a recent announcement that we think is worth knowing. All right, other considerations from the CRA as they relate to COVID-19. Here's one that may apply to you, maybe not. You may have heard discussion about this in the news recently. When CERB was first introduced, one of the eligibility criteria for receiving CERB was that you needed to have at least $5,000 of income earned in 2019 or in the 12-month period prior to applying for CERB. Now, for self-employed individuals took that as okay. A lot of self-employed individuals took that as okay, as long as I had $5,000 of gross revenue earned, right? I'm talking about sole proprietors here, self-employed people. As long as I had $5,000 of gross revenue earned, then I would be eligible to receive CERB. So they applied, and a lot of them received CERB. The problem is the government didn't clarify whether that $5,000 threshold was $5,000 gross, which is before expenses, or $5,000 after expenses. Their intention was that $5,000 threshold was supposed to be net after expenses and not gross. but they did not communicate that effectively to the self-employed community. And many self-employed individuals who had $5,000 gross, but less than $5,000 net, applied for CERB, and they actually received it. But then they received letters from the CRA saying they needed to repay this benefit. So that created an uproar in the community, and the government had to clarify their position. And recently, on February 9th, the government indicated that those who receive CERB based on their gross income will not have to repay their benefits. They're going to allow those individuals to keep the benefits. All right, so that is a recent announcement that was made on February 9th. It might bring some comfort to self-employed individuals who were worried that they might have to repay this benefit. So keep that in mind. Another point, support for families with young children. Last year, in the fall of last year, I believe it was, the federal government announced that for 2021, they're going to be providing for tax-free, we don't see that very often, but for tax-free payments of $300 per child under the age of 6 to families, to certain families. Families that have a family income of less than $120,000. For families that have a family income of more than $120,000, they could receive up to $150, or I should say $150 per child under age 6. Okay? But in order to receive these benefits, and again, not all families are going to receive these benefits. It's targeted to low and middle income families. So your higher income families who are not eligible right now for the Canada Child Benefit shouldn't expect these payments. But to the extent that your family is currently receiving Canada Child Benefit, you would be eligible for these additional 4 payments. Okay, subject to your income. Now, in order to receive these payments, though, you must file tax returns for 2019 and 2020. The first 2 payments are based on your 2019 tax return. Your last 2 payments are based on your 2020 return. So the moral of the story here, if your family receives Canada Child Benefits and you want to receive these additional payments here as indicated by the government, you have to be timely and file your tax returns to receive these benefits. So be mindful of that. Other COVID-related news from the CRA. I don't know how many of you guys have tried to call the CRA in the past. I have, right? I see that John has there too.
Many times, yeah.
Yeah, it's a bit of a nightmare, right? Not trying to disrespect the CRA, but you know, you call and sometimes you're on hold for forever, it seems, to get a hold of an agent. And then sometimes when you do get through, you question some of the information that you receive. The CRA has indicated that they've received additional funding to add additional call center agents. So this presumably would reduce the wait times when we call in. And they've also introduced a new callback service. So as opposed to staying online for however long, you can now just leave your number and they'll give you a call back. So I thought it was an interesting point of note that I came across as I was preparing this presentation. So I threw it in the presentation. And also the government, the CRA, has indicated that they're extending their call center hours for tax season beginning February 27th. So you can get them, within these hours, noted here. All right.
One quick point, you brought something up for me too that a lot of people don't necessarily know, is that the CRA is not liable for any of the advice they give you over the phone.
Right.
And quite often they make mistakes. So It's always good, especially if you get advice from calling the CRA call center, to double check. If you have an accountant, check with your accountant, quick Google search.
Yeah.
I run into it all the time where you get mistaken information from the CRA. And if it comes down to it, you're the one who's personally liable. The CRA, they can take no responsibility for the advice they give you. So.
And that was part of the problem with the point number 1, where we talked about self-employed individuals applying for CERB based on gross income as opposed to net income. Well, a lot of them applied and thought they were eligible based on gross income because they were told that by the CRA, right? So then they were surprised to see that they received letters saying they have to repay the benefit. So your point, John, is a good one. You can call the CRA and get some guidance. And look, they'll be pretty good with certain things, right? If you call them to get your RSP contribution limit or your TFSA contribution limit or whatever the case may be, and they have that information in front of them, they're you're probably pretty reliable with that kind of information. But depending on the level of your question, you know, you want to be careful about some of the information that you get from them in that regard. All right, good. So shall we move on to the next section then? Still on COVID and how COVID is going to impact your tax return. We want to take a minute here and talk a little bit about home office expenses. Okay, because this is another area where COVID and your taxes intersect. All right. And there's been a lot of discussion recently about home office expenses and what can and cannot be claimed on your 2020 tax return. And the government has recently come out with a new simplified process for claiming home office expenses specifically for the 2020 tax year. So it's temporary, only for the 2020 tax year. And it's only as it relates to employees. So for self-employed individuals who are claiming home office expenses, the truth is you could always claim home office expenses for self-employed individuals, right? There's a different process, a mechanism to do that. And you would claim those home office expenses prorated based on certain factors, prorated on the size of your home relative to your office, prorated based on how much you use that home office for work versus your personal use. That's always been there for your self-employed individuals. And the truth is, it's always been there for employees as well, subject to conditions. So for employees, you had to have your employer certify and confirm the fact that you needed to work from home, and they needed to provide paperwork to confirm that you were required to work from home. Well, with COVID-19 now forcing many Canadians across the country to work from home because of COVID-19, if you consider the burden that would put on employers to provide paperwork for each of these employees so that these employees can claim certain home office expenses, it would be a huge burden on the system, both the CRA system as well as on employers. So what the CRA has done is they've introduced a new simplified process for claiming home office expenses for the 2020 year as it relates to employees, right? So what this system does is it says you're eligible to claim a deduction for home office expenses. If you're an employee, I'm talking specifically about employees now, because like I said, self-employed individuals have always had their process and that stays the same. But if you're an employee, you're eligible to claim a deduction for home office expenses for the period you work from home if you meet all of the criteria that follows. So you work from home in 2020 due to COVID-19, or your employer required you to work from home, and you work from home more than 50% of the time for a period of at least 4 consecutive weeks in 2020. So as long as you were required to work from home due to COVID, and you work from home more than 50% of the time for at least 4 consecutive weeks, then you're eligible for this new simplified process. On the new simplified process, there are going to be 2 options for you to consider when it comes to claiming this particular expense. There is a temporary flat rate method, or there is a more detailed method. For the temporary flat rate method, you can claim it if you are working from home, obviously, because of the COVID-19 pandemic. And with that temporary flat rate method, you can claim $2 per day that you work from home, up to a maximum of $400. So $2 per day, up to a maximum of $400. So that's 200 days, right? So if you work from home 200 days, you can claim $400 maximum, right? Now, with this temporary flat rate method, you don't require any paperwork from your employer. Just go ahead and claim it. You don't need what you would normally need as an employee, and that's a T2200 completed and signed form from your employer. You do not need that with temporary flat rate method, and you do not need to keep any paperwork or documentation to support your claim. Go ahead and claim your $400, right? Or $2 per day, I should say, up to $400. Okay, so you can see how the temporary flat rate method will simplify things for a lot of employers and will simplify things for a lot of employees. Now, if you're saying, okay, well, that's great, but the truth is, you know, when you consider all my expenses, my home office expenses that I incur, you know, the cost is more than $400. When you consider how much I spend in heating and electricity, you know, electricity and all of this stuff that provides my home office, and when you consider how much I use my home office for work versus personal, and when you consider the size of my home office relative to my home, then, you know, the detailed method produces a claim that far exceeds $400. If that's your scenario, that's your situation, then you want to go with the detailed method versus the temporary flat rate method. All right. So know that for the 2020 year, you have this option to claim either the temporary flat rate method or the detailed method. How do you know which method is best for you? Well, that's where you sit down with your tax preparer, right? If you have somebody that specializes in taxation that helps you prepare your return, your accountant, whoever that might be, and sit down and go through what expenses you incur for your home office to determine whether it's more than or less than this $400 claim. If less, then perhaps you want to go with the temporary flat rate method. If it's more, then you want to go with the detailed method. But know that with the detailed method, you need to have that signed form from your employer. You must have it. Okay? And you want to keep your paperwork to support not just that T2200, but any receipts, any of that stuff that you spend on the home office expenses. You want to keep that to support your claim in the case of an audit. All right. So you've got those two methods. Temporary flat rate method. You don't need to itemize your expenses. You don't need to keep supporting documents. It's pretty simple, up to $400 claim. With the detailed method, you can claim things like electricity, heat, water, you know, utilities, home internet access fees, you know, minor repairs on the home relative to the office space. So you can see that the list is more expansive with respect to the things that you can claim under the detailed method. But again, in order for you to claim that, you need to have something from your employer saying you were required to work from home. You need to have that T2200 signed to allow you to claim that. Here's what the T2200 or T2200S look like, just a portion of it each.
And actually, real quick, we had a quick question.
Yeah.
Do the home office expenses apply to interns, the claim?
Do they apply to interns? I don't see why they wouldn't. You know, if you are working from home, there's no specific, all it really says is you need to be an employee. So if you have an employer and you're working from home, you can go ahead and claim your $400. Right?
Okay. Perfect. And I've also heard on, you know, as well, that there's a little bit of a difference between owning and renting a property, which would be better, detailed or the flat rate.
Right. Yeah. Okay. So I know where that question is going. If you own your home and you're paying for your utilities, right, separate utilities, then your total amount that you spend on each of those utilities, you put them all together and you have X amount. In some cases, all of those costs are folded into your rent when you're renting, right? You know, you've got all your utility costs built into your rent, in addition to the cost that you're actually spending to occupy that. So in some cases, what we see is those who are renting can actually deduct a lot more than those who own their home, right? And certainly for those who are renting, we see a lot of situations for those who are renting will have a much higher claim, in which case it makes sense to go with the detailed method as opposed to going with the flat rate method, where your claim is much more limited. So I have heard that argument as well. And I think it makes a lot of sense if you're paying, you know, high rental costs, for sure.
Great.
Right? So
And
here's your T2200, your T2200S, and this the CRA has come out with a calculator that you can use to estimate what your claim might be. So this might be helpful to you. Go in there and you can indicate whether you're going to claim the temporary flat rate method or the detailed method, and it can, you know, you can input some data in there and it'll spit out which claim is better for you. So know that we've talked about the self-employed individual. All the stuff I just talked about is for employees. The self-employed individual has had a process in place for some time. This just goes through the details there. So that's all I want to say as far as home office expenses.
And yeah, do we have a quick time? We got 2 more questions here for that section before we move on. That works. So the first one is just for clarification about the $2 for each day worked from home.
Yep.
Will we be able to include vacation days that we took in 2020?
Any days off are not included, right? It's funny, I was looking at these rules just before I jumped on this call, and it says any days that you have off are not included. So if you're not working from home, then you wouldn't be able to claim that $2. I didn't specifically see vacation days on that list, but if you're on vacation, you're not working. So I wouldn't think that you'd be able to claim the $2 for the days that you're off. But John, maybe you note that question and I can double check it, and we can circle back to the person who asked that after.
Perfect. And yeah, and a lot of this stuff is very new, so things could change as well, right, as we're going through these things. So
yeah.
Let's make that
note.
And
that. I mean, that's a very good question. My instinct here tells me that no, you cannot, because I didn't see it on my list of eligible days that you can claim for that $2. But note that question, John. We'll circle back to the caller after.
Perfect. And another question is, does designating a home office impact the tax-free status of that portion of the home relative to capital gains when you sell the home?
What you don't want to claim. Okay, and I think I know where this question is going.
Yeah, impact on the ACB of non-principal residents, essentially.
Well, it could be that, or it can be there's something that says when you sell a home, there's a principal residence exemption that you can claim, but your principal residence exemption claim might be impacted if you're claiming CCA, right? Capital cost allowance is an expense, a depreciable expense that you can claim in some cases. The problem with claiming CCA is that it impacts your principal residence exemption, right? So what I would say is you can go ahead and claim whatever expenses you need to claim, but you'll want to stay away from claiming CCA, capital cost allowance, because to the extent that you're claiming capital cost allowance, it can impact your principal residence exemption claim. I don't know if that answers the question or not, but
hopefully that does, and if not, feel free to ask a follow-up question. Oh, it does.
And that's a great point, Wilmot. Thank you.
Good. Any more before we move on to our next section? All right. Okay, how are we doing for time, guys? John and Evan, are we doing okay? How much more are you giving me?
We scheduled about 11 minutes.
11 minutes. Okay. Well, I'm going to jump into the next section here, and you let me know when I need to wind down. All right. What I want to talk about next is we're gonna move into common tax filing mistakes that Canadians make at tax filing time. All right. And there's a few things that I want to go through here, though. I'm going to be respectful of time. I know we only got 11 minutes, but I want to point out a couple things here. Mistake number 1, incorrect reporting of ITF income. Not going to spend too much time here, but here's the point. The point is, as mentioned earlier, Canada's tax system is what we call a graduated tax rate system. The more income you earn is the higher your tax bill will be. The system is also based on the individual. It's not based on the family. So I don't file a joint tax return with my spouse or common law partner. Yes, I report my spouse or common law partner's income on my tax return, but my tax rate and my tax bracket is not driven by my spouse's income, right? So what that does is it creates an opportunity for me to split income within my family. To the extent that I can shift income from myself to my spouse or common law partner or to my children, then it can reduce tax payable for the family. Just turning off this phone that's ringing here. Sorry about that. So it can reduce tax payable for the family. The problem with income splitting, though, is the government will only allow you to do so much of it. If I could just simply take assets, give it to my spouse, and have my spouse invest those assets, knowing that my spouse is at a lower tax bracket and tax rate, if it was that simple, everybody would do it. And government revenues would go down. So the government has limited the extent to which we can income split. So what we see here, this particular slide is talking about income splitting with a minor child. Now, minor children cannot establish a contract. So if we want to put money aside for a minor child, or if a minor child wants to invest their own money, very often that has to be done through what we call an ITF, or in trust for account. And what happens is, you have a trustee, parent or guardian that might establish this account, and you have the minor child is the beneficiary, but the parent or guardian's name is on as trustee, and very often the tax slips are sent to that individual. Now, that does not necessarily mean that that individual has to pay tax on all of the income or gains. It just means that that person should ensure that who needs to report the income does. Right? So the point I want to make with this slide is, if you have an in trust for account for children and you receive a T3 or a T5 tax slip, we need to know how to report that income. And what the rules are under the Tax Act is that income, so interest and dividends, is normally taxed back to the related parent who contributed that money, but capital gains remain taxable to the minor child. That's the general rule. All right. And that applies if you're using an in trust for account, or it applies if you're not using an in trust for account and the child is investing the money in other ways. So be mindful of that, and be sure to report ITF income the right way. This slide just speaks to that a little bit more. And
I know you made a really good point too, that we talk a lot too about clients, and it comes up a lot, is, you can't just pass off income to your lower income spouse.
Right.
So I do know that we've talked to a lot of people, just so they know there are some things you can do around it. One of them we usually talk to is prescribed rate loans, right, which can be a particular effective strategy right now. So not really part of this presentation, but I just want to let people know there are ways potentially around it. It's not for everybody, but we have talked to some people about that in the past. So.
And also, Wilmot, the last point on your last slide is an excellent one. So I just want to point that out to people as well. We can have conversations around that with clients later, but it's also a strategy that we can use.
Yeah, you know what, and like I said, I mean, income splitting can be effective. The government has certain rules in place to limit income splitting, but even though there are certain rules in place to limit income splitting, there's still a long list of strategies that you can engage to still effectively split income. And this is the value in working with financial advisors. Financial advisors can help you to understand the different ways that you can perhaps split income within your family to reduce tax payable for your family as a whole. All right, let's move on to mistake number 2. Not fully considering the taxation of vacation properties. So perhaps you've got your principal residence that you're living in, your primary residence, but then you've got another vacation property. You've got a cottage somewhere, right? Have you considered what the taxation looks like on that property when you sell it? Here's Nathan. Nathan sold his cottage last year. Details of the transaction were as follows. It originally cost him $200,000, or perhaps he inherited it from a parent, but his cost is ACB, or his cost was $200,000. He added some renovations to the property, and we'll say they were capital expenditures, because there's a difference between current expenditures and capital expenditures. I'll talk about that in a minute. But where you have renovations that are capital expenditures, you add that to your cost. So the ACB, Nathan's ACB, $250,000. Now, at the time of sale, the cottage did really well. He sold it for $800,000. So what happens? Well, what happens is he's got a tax bill. And that tax bill is $147,000. Right? Now, this is Nathan selling the property before death. This is the same implication that would happen if Nathan died with the property. He'd be deemed to have sold it just before death, and unless transferring it to a spouse or common law partner, he'd have the same income tax liability, and then he'd potentially have probate tax on top of that. So the bottom line is we need to be mindful of taxation on all of our assets, and especially vacation properties that we might have, right? Cottage properties that we might own, and so on and so forth. So the question here is, are there any tax saving strategies that Nathan could have considered or can be considered at the time of death or the time of sale? Number one, add capital expenditures to ACB. I talked earlier on about those renovations. Most people think whatever renovations they do, whatever costs they incur, they can add to ACB. Technically, that's not true. The only costs you add to ACB are what we call capital expenditures, things that improve the value of the property as opposed to restoring the value of the property. So for example, if I tear up the carpet was old, I tear up the carpet and I put the carpet back down again and just restored that carpet, right, with new carpet of equal quality or value, then technically that's a current expenditure that does not get added to ACB. On the other hand, if I tear up the carpet and I put down hardwood floor, that's something that improves the value of the property, and that gets added to ACB, right? So consider your expenditures and consider if they're capital expenditures and if they are added to ACB. Number two, receive sale proceeds over time. Perhaps you're selling it to your kids. Your kids can't pay you all up front. Perhaps they'll pay you out over time. If they're paying you out over time, you can actually spread your tax bill out over time to up to 5 years. And that can help save you tax because you're not taking it all into income in 1 year. You're spreading it over 5 years. It keeps your taxable income down, and perhaps it keeps your tax rates down, right? Number three, gift or sell the property before death. That can save you some estate administration fees. Call it probate tax at death. Or you can consider the principal residence exemption. Well, wait a minute. Aren't you supposed to claim the principal residence exemption on your primary home that you're living in and not your cottage? Well, the tax rules allow you to make the decision with respect to which property you want to use that exemption on. You can use it on your quote unquote city home, or you can use it on your vacation property, but you only have one claim per family unit. All right. So those are some strategies for minimizing taxation or vacation property. So don't make the mistake of not considering what to do with your vacation property and its related tax bill at tax filing time. All right. Mistake number three, failing to split eligible pension income. Now, for those of you who have a tax preparer that helps you with your tax return, you're probably already splitting eligible pension income to the extent that you can. But for those of you who are not sure, go back and check your tax returns to make sure that you are where you're eligible. And for those of you who file your own tax returns, prepare your own tax returns, make sure that if eligible, you are splitting eligible pension income where it makes sense. Since 2007, up to 50% of eligible pension income can be split between spouses or common law partners. It's a tax return transaction, so there's no exchange of cash flow here. It's all done on a tax return. And the amount or the types of income you can split depend. They depend on your age, and they depend on the source of the income. So if I'm any age and I'm receiving periodic payments, we'll say monthly payments from a pension plan, I can split up to 50% of that with my spouse or common law partner. That's reporting that 50% on her return. I report 50% on my return. And, you know, it can it can save us some tax. I need to be 65 or older if I'm going to split RIF payments, lift payments, or certain payments that I might receive from insurance companies, annuity type payments. So if we look at an example of how this would work, here we have Colleen and Phil. Colleen had eligible pension income of $60,000, and Phil didn't have any eligible pension income. So when Colleen pays tax on her $60,000, she pays $10,757 in tax. Phil doesn't pay any tax, so total tax for the family is that amount. If Colleen splits that pension income with Phil, then they each report 30, total tax paid $6,900. They've just saved $3,700 in tax just by how they file their tax return. Okay, so the point here is, you know, if you're receiving eligible pension income is payments from a pension plan if you're any age. It's RIF or LIF income if you're 65 or older. It's certain annuity payments if you're 65 or older. Look into splitting these payments with a spouse or common law partner if you have one, because it can save your family some tax.
And I do just two quick things. So one, I just want to acknowledge that, you know, it's 6 o'clock. So, you know, if you're okay, Wilmot, if you want to go to like maybe another 10 minutes or so, if that works. And we did have two questions. James, I'm going to ask your question at the end if you're able to stay. And we did have one other question here as well. Does my spouse also have to be over 65 for the pension splitting?
That's a great question. So what I said is your ability to split this income depends on age, right? So I said, let's assume that I'm receiving the income. I said that I could be any age and split periodic payments from a pension plan. But I also said I must be 65 or older to split RIF payments, lift payments, and certain annuity payments. That age requirement is for me. My spouse can be any age. So I can be 67 and my spouse can be 57. And I can split my RIF payments with my spouse, right? I could be 60 and my spouse can be 50, and I can split my periodic payments from a registered pension plan with my spouse. So that age restriction is based on my age, the person who's receiving the income, not the person who will receive the transferred split income. Okay. All right. So let's go on here. Mistake number 4, not taking advantage of loss carrybacks. I'm not going to say too much here on this because I want to spend a little bit of time on the next point. But all this is look, if you have generated capital losses, I mean, in the investment world, we like things that go up, right? So we always like talking about capital gains. But the reality is markets go up and markets go down. And sometimes there's losses. And when there are losses and we trigger those losses, we have what we call a realized capital loss. And if you have a realized capital loss, we don't like those, but there is a silver lining in the dark cloud. And that silver lining is you can use that loss to offset other gains that you might realize, right? So if you have realized capital losses in 2020, you can actually take those losses and apply them to any of the previous 3 years. So 2017, 2018, or 2019, you can apply them to any capital gains that you had in those years, and it can actually create a tax refund for you from those years, right? If you have capital losses that you cannot carry back to previous years, perhaps because you didn't have gains to offset them in those years, you can carry those losses forward indefinitely and use them in future years. So the point I'm trying to make on this slide is, if you have losses, don't just assume that you're out of luck. Use your losses so that you can, again, put a silver lining in the dark cloud. All right. So talk to your advisors about that. Your financial advisors, talks to your accountants about that. And if you have losses, you might be able to make use of them. Mistake number 5.
Sorry, I was going to say, we actually call that tax loss harvesting. So it's actually like you're going out and, you know, actually doing that intentionally if it's advantageous. So just to note that.
Yep, good point. All right. Mistake number 5, not reporting specified foreign property. All right. Okay. When you sit down to prepare your tax return, one of the first things you do on a tax return is put your name on it. What is your name? John Smith. What's your address? 8123 ABC Street. What's your SIN? Put in your SIN, all of that. A little further down, you run into this box, foreign property. Did you own or hold specified foreign property where the total cost amount of all such property at any time in 2020 was more than $100,000? Yes or no? There's a lot of people who aren't familiar with this box. There's a lot of people who habitually and traditionally and consistently just tick off no. Because there's a lot of people who do not have foreign property that cost $100,000 or more. Now, a point here. When I say $100,000 or more, I'm talking about total cost of all your foreign assets. I'm not just talking about one single asset, right? If the total cost of all of your foreign property, it's defined as specified foreign property, exceeds $100,000, you need to tick off the box yes. And if you tick off the box yes, you now have to complete Form T1135, which is Form Income Verification Statement. There are significant penalties for not filing the T1135. So what is this all about? Well, what this is all about is the government saying, hey, you know what? We want to know if you have foreign property. Notice I didn't say anything about income from that property. They just want to know that you have it. And they want to know that you have it because ultimately they expect that you'll receive some income or you'll sell it at some point in time. And they want to be able to track that property and make sure that you're reporting any income or gains from that property on your Canadian tax return, because income from your foreign property is still taxable on your Canadian tax return. As Canadian residents, we are taxed on our worldwide income. So the government wants to know what foreign assets you have. Even if you don't have any income in the current year, they want to know what foreign assets you have. And to the extent that those foreign assets, total of the foreign assets, exceed $100,000, you need to tick the box yes and complete T1135. All right? So it gathers information on foreign assets owned by a Canadian taxpayer where total cost exceeds $100,000. Then you need to file this form. Failure to file penalty is normally $25 per day, up to $2,500. And there can be additional penalties in the case of gross negligence. What is specified foreign property? Funds on deposit in a foreign country, shares in foreign corporations, foreign bonds and debentures, mortgages, real estate situated outside of Canada, unless it's a personal use vacation property. Your personal use vacation property does not fall into this category, interestingly enough. An interest in foreign insurance policy, precious metals, and so on, held outside of Canada. What is not specified foreign property? Any of these assets held within a Canadian mutual fund. Right? So if you want to hold foreign property and you want to avoid T1135, you can hold it within a Canadian mutual fund. And you avoid this T1135 filing requirement. Personal use real estate, so your vacation property outside of the country does not need to be reported here. And any specified foreign property that you hold in RSPs, RIFs, or TFSAs, or that you use exclusively in carrying on an active business is not specified foreign property.
And this was, I do want to point out, when we were back at the bank, we had to deal with this a little bit more frequently. People who had shares in foreign corporations and stocks and things like that. So just like with our clients and in our portfolios, because of the way we manage them, you wouldn't necessarily have to fill out this form, because I imagine that question might come up.
There you go. Right? So just a couple of frequently asked questions here real quick. Does specified foreign property held in a Canadian mutual fund have to be reported T1135? We answered this already. The question is no, it doesn't. A Canadian mutual fund in and of itself is excluded from the definition of specified foreign property or specified Canadian entity. So the fund itself does not have to file the T1135. Also, the investor in that mutual fund does not have to report their investment in the fund. because it's not specified foreign property. So Canadian mutual funds can help you avoid these rules. Assume that I, in 2020, held shares in a foreign corporation with a cost amount of $75,000, and at the same time, I had a bank account in the U.S., $35,000 on deposit. Am I exempt from filing T1135 since neither of the properties has a cost that exceeds $100,000? The answer here is no, you're not exempt. You must still file the T1135 since the total cost amount of all your foreign properties exceeds $100,000. Frequently asked question. Canadian residents must file T1135 when the cost amount of their foreign property exceeds $100,000 at any time during the year. Does this mean that a person does not have to report income from their foreign property where the cost amount of that property is below $100,000? This T1135 has nothing to do with income. CRA just wants to know if you have foreign property. And then if you are also generating income from that property, you still have to report that income as taxable income on your Canadian tax return, right? So for Canadian tax purposes, Canadian resident taxpayers must report included income, all the income they earn, regardless of the cost amount of the property. I think this, I'll end on this slide, given that we're at time here. A bonus mistake: not paying taxes owed by April 30th. We talked about this already. Tax returns normally due by April 30th. Self-employed persons have until June 15th. But if they owe taxes, the taxes must be paid by April 30th. We note the targeted relief for certain taxpayers, $75,000 or less. If you receive COVID benefits, you've got until April 30th, 2022 to pay your tax bill. Penalties for filing late are normally a late filing penalty of 5% plus 1% per month outstanding, plus interest on any amounts owed. So I'm going to stop there just because we're at time. I'll just give a nod to RSP season again. Speak with John, speak with Evan if you're interested in making RSP contributions. Here are your limits for 2020 and 2021. I'm going to stop there and I'll turn it over to John and Evan if there are any questions. Thank you for your time, guys. Appreciate you.
All right.